Japan is back. That's what the headlines say. That's what the stock charts scream. That's what politicians whisper softly into microphones right before elections. The Nikkei is up. Corporate profits are up. Share buybacks are up. Executive bonuses are up. Everything is up except the one thing that might matter to actual humans: living standards. Japan didn't recover. Japan rebranded poverty as efficiency and sold it to global investors with a bow. This chapter is about that word everyone keeps abusing: recovery. Because if this is a recovery, then gravity is optional and math is just a suggestion. 1. Stock market heaven, ground level hell. Let's start with the numbers investors love, because they never ask uncomfortable questions. EPS looks healthy. PR looks reasonable. PBR is finally above 1 for companies that spent decades being financial zombies. Share buybacks are at record highs. Foreign capital keeps flowing in because the yen is on clearance sale. On paper, Japan looks like a disciplined, shareholder-friendly paradise. On the street, it looks like full-time workers with zero savings, dual-income households still unable to buy property, elderly people working convenience store night shifts, young people treating marriage like a luxury brand they can't afford. The stock market didn't rise because Japan got richer. It rose because labor got cheaper. That's not recovery. That's cost optimization with a PR team. 1. The secret fuel: cheap people. Japan's revival runs on 3 fuels: frozen wages, precarious employment, corporate internal reserves hoarded like a dragon's gold. Companies didn't increase productivity through innovation. They increased profits by cutting labor costs, expanding non-regular employment, avoiding wage hikes even during inflation, letting households absorb all the pain. Inflation arrived. Wages stayed polite and silent. So when you see stock prices climbing, remember, someone paid for that climb. It just wasn't the shareholders. It was the cashier, the warehouse worker, the office lady with a permanent temporary contract. Japan didn't recover. It shifted the bill downward. 1. Real estate, asset inflation, human deflation. Now let's talk real estate, because nothing screams healthy economy like houses nobody can afford. Urban property prices are rising. REITs are doing great. Foreign buyers love Tokyo because it feels cheap compared to New York or Singapore. Meanwhile, Japanese salaries haven't caught up in 30 years. Mortgage affordability is a fantasy for younger workers. Renting forever is no longer a phase, it's a policy outcome. This is asset inflation without income growth, a classic sign of a financialized economy that stopped caring about households. Japan didn't rebuild its middle class. It built beautiful balance sheets and called it national progress. 1. Government narrative versus household reality. The government keeps repeating the same mantra. Corporate profits will eventually trickle down. Eventually. Any decade now. But here's the problem. Corporations are not confused. They understood the system perfectly. Why raise wages when workers won't quit? Labor unions are weak. Non-regular employment keeps people desperate. Social pressure punishes job hopping. The system rewards hoarding, not sharing. So companies hoard, and the government applauds them for being globally competitive. Japan didn't recover. It optimized inequality with Japanese politeness. 1. This is not a bug. It's the business model. Let's be clear before anyone accuses this video of pessimism. This outcome is not accidental. It is structural. A weak yen boosts exports. Low wages boost margins. Stable poverty keeps inflation politically manageable. Stock gains attract foreign capital. From a purely financial perspective, Japan is doing exactly what it designed itself to do. From a human perspective, it's quietly cannibalizing its future. Pause here, but not your brain. If this already makes you uncomfortable, good. That means you're still human. In the next chapter, we'll dissect why Japanese stocks can soar while households sink, and how global investors profit from a country that politely underpays its own people. Before that, hit subscribe, because algorithms respect commitment press-like, because this channel is allergic to economic fairy tales. Share this video with someone who still believes stock charts equal national happiness. Here's the puzzle global investors pretend not to notice. How can a country have record corporate profits, booming stock prices, and households that can't save money? Short answer, because the stock market is no longer connected to daily life. Long answer, welcome to Japan's perfectly engineered financial separation system. 1. Stocks are not the economy. They're a filter. Once upon a time, rising stock prices meant higher wages, more hiring, better living standards. That relationship is dead, buried, cremated, memorial service cancelled. In Japan, the stock market filters reality through 3 layers: large exporters, financial engineering, currency distortion. The average Japanese worker is not inside this system. They are outside it, waving politely. When the Nikkei rises, it's not saying Japan is richer. It's saying large corporations optimized costs and shareholders approve. Workers are a cost. Shareholders are a priority. The market made its choice years ago. 1. EPS looks great because labor is silent. Let's talk about EPS, the holy scripture of investors. Japanese EPS looks solid not because sales exploded, but because wages barely moved, headcount stayed flexible. Productivity gains came from pressure, not innovation. Japan didn't grow profits. It compressed people. When inflation hit, companies didn't panic. They simply passed costs to consumers and kept wages calm and obedient. That's not efficiency. That's social endurance monetized. And Wall Street loves endurance, as long as it's not theirs. 1. Buybacks, the quiet confession. Nothing reveals the truth like share buybacks. Japanese firms are sitting on massive internal reserves, cash piles so large they've become a national hobby. Instead of raising wages, investing in domestic demand, rebuilding household balance sheets, they buy back shares. Buybacks say, we don't believe investing in our own society will generate returns. That's not confidence. That's an admission. Investors cheer. Workers stay invisible. 1. The weak yen is a feature, not a crisis. Global headlines scream, weak yen crisis. Corporations quietly toast champagne. A weak yen means overseas revenue looks bigger, exports become cheaper, profits inflate without effort. Meanwhile, imports get expensive, food costs, rise energy bills, climb households, absorb the shock. Currency depreciation transfers wealth upward. It always has. Japan just does it with excellent manners. 1. The household balance sheet is the sacrificial altar. Here's the part nobody puts in earnings calls. Nearly half of Japanese households have little to no savings growth, rising living costs, stagnant wages, zero asset appreciation. They don't benefit from stocks. They don't benefit from real estate. They don't benefit from currency moves. They exist to stabilize the system. Japan didn't choose shareholders over citizens by accident. It chose predictability, a predictable workforce, a predictable cost structure, a predictable social silence. Markets love predictability. Democracy, less so. Reality check, Japanese stocks are strong because households are weak. That's the trade-off nobody admits out loud. The stock market is not lying. Politicians are. If you want more chapters that explain what the headlines won't, subscribe so this doesn't get buried under travel vlogs, like so algorithms understand this matters. Share it with someone who still thinks stocks up means life improved. Next chapter, we go deeper. How Japan turned wage suppression into a national growth strategy and why reversing it now might be impossible. At some point, Japan stopped trying to grow incomes and started trying to manage expectations. This chapter explains how wage suppression wasn't a failure, wasn't temporary, and definitely wasn't accidental. It became policy, quietly, politely, permanently. Japan didn't lose wage growth. Japan engineered its disappearance. 1. Stability was code for don't ask for more. After the bubble burst, Japan learned one lesson very well. Unstable wages scare corporations. Stable poverty does not. So the system pivoted. Lifetime employment turned into lifetime anxiety. Raises became symbolic gestures. Bonuses replaced salary growth, so companies could remove them anytime inflation was treated like a weather event, not a policy outcome. Workers were taught that asking for more is selfish, changing jobs is risky, endurance is maturity. The message wasn't subtle, it was cultural conditioning with spreadsheets. And it worked. 1. Non-regular employment, the masterstroke. If you want low wages forever, don't suppress pay directly, just redesign employment. Japan perfected this: part-time, contract, dispatch, temporary full-time that never becomes full-time. The genius is psychological: same workload, same responsibility. None of the bargaining power. This isn't labor flexibility, it's labor anesthesia. People keep working. They just stop expecting improvement. Corporations love it, investors adore it, households quietly absorb it. 1. Inflation arrived, wages stayed polite. When global inflation hit, this was Japan's moment to reset. Other countries raised wages. Japan raised explanations. Companies said, "We must remain competitive. Uncertainty is high. We will monitor conditions carefully." Translation: "We're fine, you'll adjust." So households did. They downgraded food quality, delayed healthcare, gave up on savings, reframed survival as discipline. This wasn't resilience, it was forced adaptation. 1. Corporate reserves, a national museum of untouched money. Japanese companies are famous for their internal reserves, cash sitting idle, growing, untaxed by ambition. Why not spend it? Because raising wages is permanent. Buybacks are reversible. Bonuses are optional. Investment carries risk. Hoarding cash in a low-growth society is rational. It just happens to be devastating for everyone else. Japan didn't lack money. It lacked will to circulate it. 1. The trap is now structural. Here's the uncomfortable part. Even if Japan wanted to raise wages now, it's trapped. Raise wages and margins collapse. Raise wages and export competitiveness suffers. Raise wages and inflation becomes visible. Raise wages and corporate Japan panics. The system optimized itself into a corner. Low wages are no longer a policy choice. They're a dependency. The stock market depends on them. The currency depends on them. The fiscal narrative depends on them. Households are collateral. Let's be honest. Japan didn't fail to protect workers. It decided workers were the shock absorbers. And shock absorbers don't get richer. They just prevent damage to things that matter more. If this chapter hit a nerve, good. That means you're paying attention. Before we move on, subscribe because uncomfortable economics doesn't trend naturally, like because silence only helps the illusion. Share this with someone who still believes patience pays interest. Next chapter, who actually owns Japan's rising assets and why most Japanese people don't. Japan is full of assets going up in value: stocks, commercial real estate, prime urban land, REITs, infrastructure plays wrapped in polite financial language. Now here's the awkward question nobody likes asking: who actually owns them? Spoiler, not the average Japanese household, not even close. 1. Asset inflation without asset participation. When assets rise, wealth rises, but only if you own the assets. In Japan, household stock ownership is low risk. Aversion is cultural and structural savings sit in cash earning nothing. Inflation quietly erodes purchasing power. So while the Nikkei climbs, households watch from the sidelines like it's a sport they were never allowed to play. Japan didn't create a nation of investors, it created a nation of spectators. And spectators don't get dividends. 1. Foreign capital, shopping in a discount store. The weak yen turned Japan into a global clearance sale. To overseas investors, Japan looks like stable governance, world-class infrastructure, cheap currency, underpriced assets, so capital flows in, office buildings, hotels, logistics hubs, apartment blocks. Foreign money doesn't care about local wages, it cares about yield, and Japan delivers yield by keeping domestic costs low, especially labor, especially rent growth relative to wages. This isn't colonization, it's capitalism doing exactly what it was designed to do. 1. Real estate. You live there, someone else owns it. Let's focus on property, because nothing exposes inequality faster than housing. Urban real estate prices rise, rents creep upward, REITs perform nicely. Meanwhile, young workers can't buy middle-aged workers missed the timing. Retirees sell to survive, ownership concentration increases. You live in the city, you work in the city, you pay rent in the city, but the equity belongs to someone else. This is how a society turns into a cash flow machine for absentee owners. 1. Pensions and institutions, the quiet beneficiaries. Yes, some Japanese money is in the market. Pension funds, insurance companies, institutional portfolios. But here's the catch. Returns are spread thin, benefits are delayed, inflation eats real value, individual control is minimal. People are told they are invested. What they really are is indirectly exposed. The upside is abstract, the downside is immediate. Markets move fast, households move slowly. Guess who wins? 1. A country where wealth floats above life. Japan has become a place where assets appreciate, balance sheets improve, capital circulates globally, while daily life becomes tighter, smaller, more cautious. This is not a developing economy. This is a financially optimized, mature economy that decided ownership concentration was acceptable. You don't need mass prosperity for rising markets. You just need stability, discipline, and silence. Japan offers all three. Let's call it what it is. Japan didn't fail to distribute wealth. It never tried. It focused on asset price stability, corporate profitability, investor confidence. Households were told to be patient. Markets were told to be rewarded. Only one of those groups actually got paid. If this chapter clarified why stocks up doesn't mean people richer, subscribe because financial reality rarely trends, like because ownership matters more than optimism. Share this with someone who thinks rising markets lift everyone equally. Next chapter, the final one. Why this model looks successful on paper but quietly erodes the future. On paper, Japan looks like a case study in discipline. Low unemployment, stable society, strong corporate profits. Rising stock market, no riots, no chaos, no noise. Global analysts love this. Investors admire it. Consultants point at it with laser pointers. And yet something is rotting underneath. This chapter is about why Japan's fake recovery doesn't collapse loudly, but decays quietly, and why that makes it far more dangerous. 1. When survival replaces ambition. A society can survive for a long time without hope. It just can't innovate. Japan today is full of people who avoid risk, avoid debt, avoid job changes, avoid children, avoid long-term plans, not because they're lazy, because the system punished ambition repeatedly. When wages don't grow, ambition feels irresponsible. When housing is unreachable, planning feels naive. When retirement looks uncertain, joy feels expensive. This is not cultural decline. This is economic incentive design working perfectly. 1. Demographics are not the problem. Incentives are. Everyone loves blaming demographics. Aging society, low birth rate, shrinking population. That's lazy analysis. People don't stop having children because they dislike babies. They stop because income is unstable, housing is insecure, time is exhausted, futures feel narrow. Japan didn't become old, it became unrewarding. And markets don't care. They only care that costs stay low and margins stay clean. 1. Capital is mobile. People are not. This is the core asymmetry. Capital leaves when returns fall. People stay even when life deteriorates, so Japan optimizes for capital, every time. Weak yen? Good for exporters. Low wages? Great for margins. Asset concentration? Efficient. Household suffering? Not a line item. This is why the system persists. The pain is localized. The profit is global. 1. The illusion will last longer than you think. Here's the uncomfortable truth. This model won't collapse tomorrow, or next year, or maybe even this decade. It's stable. That's the problem. Japan can coast for a very long time on social compliance, cultural endurance, low expectations. Financial engineering markets will keep rising. Headlines will keep celebrating. Tourists will keep posting photos. And inside, people will quietly shrink their lives to fit the system. 1. Fake recovery is still recovery for someone. Let's end with honesty. Japan's recovery is fake for households. It is very real for shareholders, executives, foreign investors, asset owners. The system works, just not for most people, and that's why it's so dangerous. Because it teaches the world a lesson. You don't need prosperous citizens to have a strong stock market. You just need disciplined ones. Final words. If you made it this far, congratulations. You now understand something most economic commentary avoids. Stocks up does not mean people are better off. Stability does not mean health. Silence does not mean satisfaction. Japan didn't recover. It financialized endurance. If this series made you think, question, or feel slightly uncomfortable, subscribe because this channel doesn't sell fairy tales, like because algorithms respect engagement, not truth. Share this with someone who still thinks GDP charts feed families. The stock market will be fine. The question is whether people will be.